Dear Vimal, thank you for coming on our show. As you know, real estate has been going through an amazing run, especially from 2021 to 2024. The way markets doubled every year, it was phenomenal. 2025, according to me, has been a year where value took precedence over volume. And my first question to you is, on 2026, what will the housing or industrial demand be like in this current year in 2026? What does your report say?
Uh, right, thank you. In terms of housing, what we expect in 2026, I think we expect this momentum to continue. I know in 2025, sales have largely remained stable with slight moderation, so we expect this elevated levels to continue. So key themes which we feel are going to drive the housing market in the entire country would be urbanization, surely, premiumization, and focus on green housing. So while I'm saying that demand is going to largely remain stable in terms of sales, I think the favorable factors are availability of credit at a conducive rate. We have seen that repo rates have dipped in the recent past too, and we expect the interest rate cycle to be favorable. So that apart, we also expect the market to remain strong. Tier 2, Tier 3 cities are expected to remain prominent. Now, what is going to drive these is, I think, infrastructure initiatives, improving regional connectivity in terms of expressways, newer airports, port development. So these activities are definitely going to spur a lot of real estate activity. In terms of bigger cities, when we're talking about in bigger cities as well, the fringe areas, the peripheral suburban districts are expected to receive a major boost in this year, especially due to major connectivity related developments happening. So overall, we feel demand to remain steady at this elevated level. Talking about industrial, I think industrial has been on an expansionary mode in 2025. So our estimated numbers for 2025, I think we feel it should easily close somewhere between 30 and 40 million square feet. And so what is driving? Obviously, 3PL is driving, e-commerce is driving, engineering, manufacturing is driving. Other important factors for 2026 would be, I think this momentum is going to continue. There is a favorable policy push. There is definitely definitely the fact that 3PL will continue to drive. Tier 2, Tier 3 cities will come up, as in case of housing, because we are seeing a lot of major infrastructure initiatives in terms of development corridors, multimodal logistics parks, plug and play infrastructure initiatives, as well as grade A warehouses. So the future and as well as what we expect for industrial this year is quite upbeat.
My second question to you, Vimal, is that we have seen a lot of technology intervention happening in the real estate space, especially through fractional ownership. We've seen a lot of startups coming in this space. And I just want to understand this space better from you. And my question is, what will the fractional investment segment in the residential market look like in 2026?
This is an interesting question because fractional ownership has received a much more regulatory push as well as the regulatory phase, I would say. So estimated numbers talk about easily 5 to 10 billion of investment in varied forms in unorganized fractional ownership platforms. So this also presents immense scope for this fragmented market to be regularized in the coming future. In terms of housing, we feel there's a lot of interest in luxury housing, in villas, in second homes, in vacation homes, all in all premium housing. We are also seeing active interest from NRIs as well as HNI community in this segment. So in terms of overall market, I feel it's going to be an interesting year wherein I think that there will be a lot of regularization happening in terms of more fractional ownership platforms getting more facelift, as well as we'll see a lot of traction similar to what we have started seeing the office segment.
My third question is based on the way real estate has been transforming in the last couple of years. The alternate asset classes like warehousing, industrial housing, even a lot of action on REITs, etc. have been happening. So my question is that can investing in warehousing and especially flexible spaces, which has really grown a lot in the last couple of years, can they give us an average or more than average return over the next 5 years? And for me, the average return would mean like, beating the 7% return which a fixed deposit rate might be giving today.
Right. I think as we are talking, I think in terms of interest rate cycle and all, on average, if you're talking about 5 year FD interest rate is also, I'm sure it's hovering somewhere below 7%. So even the GSEC rate is around 6.6% below 7%. So talking about gross yields in real estate different segments, so our understanding is housing continues to be at the lower end, which is about 2.5%. In terms of commercial real estate, which has office ranges between different markets between 8 to 9, retail would be somewhere up to 10%. So we feel that industrial warehousing, as well as industrial warehousing, hovers around 7 to 8%. Alternatives, which includes co-living as well as flex, is around in the range of 6 to 7%. So somewhere it is, so real estate, when we see in terms of housing is somewhere on the lower side. I think other segments within real estate is definitely has better yields. Here I'm talking about pre-tax gross yields. So in terms of the interest rate cycle right now at the stage where it is, I think it appears to be more obviously advantageous to put the money as well, money into real estate as well, and have a more diversified portfolio.
Thank you, Vimal. Your answers have been really insightful. I'm sure our audience is going to really get benefited a lot from it. My last question for you is that, is it better to invest in REITs or a real estate mutual fund? What is the difference between them? Especially for the working middle class, is this an important asset allocation product in the wealth management space?
I think difficult to answer in terms of a point blank thing, but I think our understanding so far is REIT is still at a very nascent stage. We have about 5 REITs, and I think an annualized return, if we talk about, which includes dividend distribution yield plus appreciation one, somewhere ranges between 10 to 15% or so, and could be on the higher side in select cases. In terms of mutual funds, it is, again, so mutual funds varies in terms of what type of mutual fund it is, whether it is equity, whether it is debt oriented, but I think an average could be similar, somewhere around, it can be lower at 10, 11%. I'm talking about a very average annually return over the last few years. And it can be as high as 15 to 20% also. But I think here the difference depends upon what type of the investor is and his factors, like what asset is he looking at, what is the time horizon. Because unlike a REIT, wherein the underlying asset is pure play real estate asset, in case of mutual fund, even if it is real estate oriented or housing focused, the mix could be more diverse. It will be both real estate, which could be more housing companies. It could be more backward integrated companies, which could be cement, which could be related to construction. So if an investor wants to have a greater pie and a direct share in the current ongoing real estate investment cycle, I think REIT is, of course, a good option. But as I said, it depends what type of investor, risk appetite, time horizon, and the asset class which he is looking at.
Thank you, Vimal, once again for your insightful answers. And I'm sure 2026 again is going to be a great year for not just the home buyers, but also for investors in the real estate space.